Good turnaround Tuesday, everybody. How's everyone doing? Hi, Phil, Kevin, everyone else in here. Varun, good morning. It's not good morning where you live, is it? Well, Scott, good, buddy. All right, so turnaround Tuesday was in Europe last night. So looking at the euro, we turned here, put in a higher low, threatening this, using the 2-hour chart, threatening the 200 here. To me, this looks like a higher low. Looks good. Euro looks like we're going to have a rally at least to 109. I still think we're going to take out the 110 level. Classic stop hunt in the Dixie last night. I don't know what this candle was. It happened Friday. It must have been a ghost candle. It meant nothing because we came in here yesterday. So all we did was take out this high 40 by what, 4 points and reversed. So we have a chance for a reversal week to the downside if we close back under 99 and then 98.33. Still think there's a chance now that we're getting this, of course, over 101. You have to get out of the way, and dollar's probably going to make a new high, but I'm going to go with it. Oh, you're in El Dorado Hills. Where is that? In LA? DJ, how are you? All my trading warrior brothers and sisters, let's have a good day. Sacramento, all right. I'm in San Diego area. Alberto, how are you? Nice to meet you. Who's new to face here today? Alberto's living large in Thailand. Oh, well, you know what interview I have today? And I used to watch this guy for a long time ago. Oh, okay. Chris Carolyn of the Spiral Calendar. He's a Charles Dow award winner. He worked with Robert Proctor. Not Proctor. Proctor's self-improvement. Proctor in the old days, and this will be, I believe, Chris's second or third time here in a while. I'm looking forward to talking to him, seeing what his Spiral Calendar has on the docket in the market. So stick around for the interview today. With the dollar weakening, I think the gold has its best chance to break out over the 1700 level in the coming days. If it's not going to do it with the weak dollar, I don't know what's going to propel it. So we have that happening here, and I'm beginning to scale into S&Ps here. You know, you could use micro lots to scale in. I'll put more on if we take out this high. Still a possibility we may not take out this high. And again, remember yesterday gave you this support level right here, which is what it held from Friday's high. So again, you're going to know something's wrong if we start trading back under the 2900 level. That should accelerate things to the downside. Hi, Kaltsub, Makashi, how are things down under? Hope everyone's staying healthy and their families are okay. Everyone okay? You know, COVID's touching everyone, everything, including the White House. Okay, so remember what I say. She's back home. Thank you for asking. And that's why I say every day she's back home, Scott. So that's why I say every day. I know we're all here to make money and count pips, but you also have to count your blessings, not just your pips. So if you're healthy and you're home and your family's okay, it beats any winning trade you could do today or the rest of the year. How about that? So we're getting with this move in the dollar, it's going to be critical. I think the yen, and I talked about yesterday, has made a major turn. And right now it looks somewhat corrective here. Maybe we could get back to the breakdown. I would take a shot at 107 because this is how you get some real big levels. I guess you can't say, let's take a look at the weekly for a weekly reversal. Yeah, it's not going to take much for a 2-week reversal. Closes over 106.91. So, any pullbacks to 691 here, that's only about 40 pips or so from here. I would give it a shot, risking last week's lows, because I know it's probably premature to talk about this, but um, look at what we had here, a 10,000 pip move. And Blake, interrupt me if you have some things you want to talk about, and then get back to trading. Then why can't this just be some type of correction? I'm thinking it's complete. Some people thought we could trade 5.5. Look, everything is possible. But when I look at this, I have to give it some potential, right? I think that it has more to do with yields, Alberto, right now. And it's disconnected from everything, you know. The yen was rallying and gold was rallying, so I'm thinking it may reconnect, but more reconnect with yields. But getting back to the end, this was 1,000, right? 1160, a little over 1,000 pips. All right. So if we get some type of breakout here, I just drew this line. It's really too steep of an angle. I thought we'd get some type of triangle here. I guess we could say, let's go with this right here. So as long as we're holding 106, we're out of that. And if you take 1100 from here, that's going to give you 116. And if you take 1.618 of this, assuming this might be the low, you're talking 122, which is a lot of the US dollar yen bulls targets get up to that 120 handle or better. So, yeah, I'm thinking that it's going to be more about interest rates. And I know I've been beating a dead horse here, but it sure looks like the 10 years trying to come out of here. Why can't we see 140 again? Or even some type of fib extension of this. And TLT, here's your daily. I mean, we're back under the 50-day. We're sitting, yesterday we had a down day. Probably have a pop today with the yen lower, but it sure looks vulnerable to me, doesn't it? Like a rounding top here. In fact, we start closing under 62. You just go 172 to 62 is going to give you 52. And the moving average is going to come in the 200 right around 148. So no one's expecting higher yields because of the Fed and economic weakness. 20 million unemployed. Why should rates go up? Certainly not because of economic growth, right? So that's a narrative I'm working until proven wrong, which is long U.S. dollar yen and short interest rate futures and ETFs, etc. Gold, I'd love to see a breakout here over this 1740 level. 1720 is going to do it. People will be talking 1800. Here's my best guess. We trade up to 1740 or so, maybe take out this high and fail. So I noticed that we have all-time highs and 6 months of massive inflows into the gold ETFs, GLD, and all the other ones, actually records now. So you could interpret that as bullish. You have a lot of support of money flow going into gold. I look at it and I say 6 months we've had, all the way back here to last year, and they've been right, except for this little shakeout. Newmont, gap higher. Okay. So maybe we'll get to your 70 mark. But to me, what that expresses is something that's crowded. So we'll see. Anything else I really want to touch on? Oil, oil keeps marching along. I think it's forming some type of shoulder here. I don't know how to get rid of this to make the charts look, more real. This kind of screws up the ranges, but I really haven't touched it since then. Just a quick look at MEX, and I thought we were going to get a third drive. Looks like it's starting to roll over here. So we'll see what happens with that. And I think I've talked about quite a lot. COT, gold and silver at lows, and what? Commercials are not short. Oh, the 2011 highs. Yeah, I don't think we're going, if we're going there, then we're going much higher. I think 1750 is a big number if we start closing above it. 22, what's that, Phil? Okay, the dollar's going to break higher. All right. That's what makes the market. We'll see if the dollar breaks higher. So far, we have a nice little reversal day here. Okay, I'll go with it. I know everyone's pretty bullish a dollar. I'll go with you guys if we close over 101. Okay, until that time, we could still correct back down to support, and if we take the support out, there'll be better dollar buying opportunities, in my opinion, down the road. So, Blake, where are you coming down on the action in the dollar today? A little bit of a turn that we've had in euro. I think it looks pretty good for a squeeze.
Dale, it's it's really hard to say. The market is extremely choppy. It looks like we're consolidating, but I'll tell you, the move today, an overnight in risk, has
Yeah,
been pretty astonishing. I've been floored just watching this move. Hold on, let me go ahead and pull up the chart here. Um,
thank you.
yeah, so like when you look at like the Aussie dollar overnight, I mean, we set up a lower high here,
Yeah,
right? we
yeah,
we set up a lower high, and then the market was coming under pressure. There was some news that China is going to stop importing some Australian products. You see the Aussie came under pressure, and we've just ripped right back up to highs in Europe. I mean, Europe's pretty. I know you guys have probably heard me say this before, but I'll say it again. Europe is pretty good in reversing
yeah.
Asian moves, right? So, and if I had to put a number on it, I would say 70 to 80% of the time, like whatever you're seeing in Asia just gets unwound in Europe, and today was no exception. I didn't think it was going to be the case, just because seen we saw such a big reversal in risk yesterday. With the S&P coming off, I was thinking, oh yeah, well, this might continue here, but as you can see, the S&P is right back up too. So the dollar's extremely choppy here, and I got caught on the wrong side on the U.S. dollar Norwegian krona. I mean, I've been buying this
Wow.
thing. Yeah, I mean, this is a hell of a move. I mean, it was squeezing through 1034, and I picked this thing up yesterday over here as we had this downtrend line
Yeah,
broken, and we're retesting the actual trend lows now, which, again, I wake up this morning going, what the hell happened? And and it's not, you're talking about crude, and
yeah,
yeah, crude's up a little bit, but is it really up that much?
yeah. I
I
mean,
mean,
commensurate to that move in the currency. Wow.
yeah. So a lot of this doesn't, it doesn't um uh, make a lot of sense to me in a lot of these moves, but that's kind of the mo of the market right now, is we're consolidating these big moves, not only lower but also higher. So when I look at the euro dollar, like the euro dollar was a layup short a week and a half ago. Today, I mean, I don't know what to do with the euro down here, and that's probably a better indication right now not to do anything. Um, but it's like, I look at the dollar yen. I thought the dollar yen was going to be breaking higher overnight, as we were coming out of this, wedge, and now we're just consolidating. And that's not to say that the dollar yen can't go higher here, but excuse me 1 second, guys. I'm gonna have to sneeze.
Bless you.
Allergy season is always the best. So yeah, I mean, it's choppy, and it's very, very. I mean, here's another one that this one's caught me off guard. Um, and it has come down obviously for reasons of risk aversion. But look at the Euro Aussie. The Euro Aussie this is last night. I mean, this is an hourly chart, so you can actually see last night we are breaking higher, breaking this downtrend line on that Australian, China Australian news. We've reversed the entire move, stopped out some longs, and here we are, just below the 618. But it's like these are pretty wild moves, and I'm struggling to put my finger on the reasons why, other than just a little bit of an unwind. And that to me has been really surprising that we've seen these pretty big moves. And like I said, no one, I read. So just so you guys know, here I'll show you. We have what's called an IB manager, and I'll just put it out to here so you can kind of see. I'm gonna just so you can see here, right? These are subscriptions that our firm has to different brokerage firms, and analyst teams, and they are really good from all over the world that are kind of cluing us in reason why things are moving, analysis on on comments that were made by central banks, or President Trump or whatever, or any central banker. And everybody this morning is just kind of like, well, I guess we're in consolidation, kind of scratching their heads. Not No one could put their finger on the reason why we're seeing any of these moves, other than it's just a consolidation, and very nasty moves too on top of that. I mean, look at the US dollar Mexican peso. This is another one that was this one has really done a number on me the last 24 hours, because I was short. Fortunately, I made some money yesterday, being on the long side. Don't ask me how, but I was on the short side of the dollar mex as we were breaking down on Friday. Then we started squeezing. I picked it up long down here, made a little bit of money, which is good because it took a lot of my profits on the short side. But watching this move right now, it's like, okay, we're back above 24. This is going to create some sort of short squeeze, which it still may, because this is what I call a false breakdown, right? So this is a false breakdown outside of the triangle. Then I was thinking, when I got up this morning, I'm like, oh, we're going to be above 24. And I was surprised to see that the dollar Mexican peso is not squeezed back up towards, not 24 and a half like by this morning. I was thinking more like 24, 25, somewhere up here. I was thinking, man, this thing's going to really start to move move higher. And this may still set up like an inverted head and shoulder pattern if it can stall around these levels. But still, the reversals, like I said, that we've seen are pretty staggering. I'm very, very much surprised that we've seen these types of moves in the currency market. And the only thing that I can think of right now is the market probably got a little ahead of itself, being ready to short risk. And you had traders selling Aussie dollars in Asia, probably in mass, and then or selling dollar or selling Mexican pesos. And then, you've got this just big unwind overnight, and probably Asian traders getting stopped out, people in North America like myself that maybe gotten some trades and then put their stops in overnight getting triggered. And then, a case of, Europe just not knowing that everybody's positioned poorly overnight and just running those stops and letting them run. And I think that's basically what has transpired, and it's been nasty. I mean, these are nasty moves. For the Aussie to sit here, and this is a 15-minute chart in the Aussie, for it to grind higher. I mean, this is 64.40 to 65, almost 100 pip move in that amount of time is pretty wild. Now, I'm not going to sit here and start fading this stuff, but this is probably, let me see, if you want to be, counter trend right now, these are probably the areas where, like, if you want to sell Aussie, and I really don't want to because I've got some Euro Aussie longs, but you can see this is a big confluence right here. And, here, I can move that over a little bit, not that, move that over a little bit. So, the Aussie might pull back towards, let's just call it 65 cents. But I think because it caught so many people off guard, whether you're talking about the Aussie or the Canadian or the peso or whatever, the moves are going to be fairly limited. Like I'm gonna look at the Aussie and say, well, we're probably not going to get too much below 65 cents. We might get a little bit of a reversal, but it ain't going to be anything grandiose. I would be surprised if it was. But these look like the areas that we're going to get some sort of reversal. But yeah, it's been pretty wild, and I haven't been able to put my finger on anything. Maybe Stelios has, or Steve. Stelios, good morning.
Good morning. How are you doing?
Good. Well, I'm upside down a little bit in some of these trades, but I wanted to see, we've seen this big reverse on risk. Anything that you saw that really you could put your finger on the reasons why?
Quick answer is no. We saw the same thing yesterday, right? It was equities were down during Asian trading, and then they recovered. So I think the problem that we have now, there are two problems. One, it makes perfect sense to be short equities. That's why I think there's a big short base still, and this has to be cleared before we can make a leg lower. I've said this before many times. The other big uncertainty is what happens in the major countries which are now slowly opening up. And I was reading today about Singapore, where they have what was it, 800 new cases of COVID-19, and when they had been really, really low before. And I think this, unfortunately, I think in Germany as well, it's the same. And we opened up here in Greece a few days ago, or started opening up.
How's that working for you guys?
Well, so far we don't really have much data. It's been 3 days, so I guess it's going to be a couple of weeks before we really start seeing the effects. But
even South Korea is spiking a little bit still, and they are like the model.
Yeah.
They and I read it's clusters from
bars,
clubs and bars, which makes perfect
people
sense.
shouldn't drink out of the same shot glass.
But I mean, imagine like congregations of people getting together in big groups, and all you need is one or two people that are infected, and
yeah. No, I mean, we personally, it's opened up here, but we've only met with a couple of friends who we know are equally crazy about being safe like we are. So, it's I'm not risking anything at the moment, until we see some data. And I'm reading also, there's Wuhan, which is what, 10, 11 million people. Apparently, they're going to start testing everybody because they're new cases reported. So you imagine needing to test 10 million people. I mean, the Chinese can do it. I don't know if other countries can do it, but
they locked down another province, not Wuhan, but another one in China. So
yeah,
it's still spreading. Is the bottom line, isn't it?
Yes, and I fear that this is not the end. Unfortunately, I hope I'm wrong, but
everyone's worried about the second wave. maybe a second wave doesn't happen because the first wave doesn't end
Yep, that's a
for
good
a while,
point.
you know, anyway.
Yeah. But yeah, I mean,
It sucks.
that's what I think is still driving equities, and there's this uncertainty. And in the middle of this uncertainty, because we don't know, is everything, are we in the clear? Are we not? You know, is this over, or is it going to be over in 3 to 6 months from now? We don't know. So at the moment, the path of least resistance is still to go a little bit higher, flush out a few more shorts, get everybody in who thinks this is it. You know, we're going much higher, and then we can go lower. That's my view.
Yeah, I still don't think that the 200-day moving average for the S&P is out of reach. The one level that I've been, you know, staring at is obviously this 2,900 level in the S&P, which this is an hourly support, but you can see how well respected it is. You know, there's a resistance. We came down to, you know, test support, and we've done that multiple times now. So I think if you really want to be bearish equities, if you're like, man, I think that, you know, we're going to get a second wave, and you have all the bearish arguments. If that's your stance, I would wait till we drop below this level, this 2,900 level, personally, before you get too bearish. We are on the hourlies making some lower highs, but that may not stick either. So it's just going to be really interesting to see if this market's going to actually roll over or not. And based on what we're seeing in currencies, now is not the time. I mean, when you see the Aussie up the way it is, you see the Kiwi reversal the way it is, you know, right now is not the time that the market should show a reversal, at least not by my view. Another thing that I brought up during the daily roundup yesterday, in case you guys missed this is the VIX, okay? And this is my drawing from yesterday, so just ignore that for a second. If you want to really be bearish risk, wait for the volatility to get back above 30. As you can see, technically, we broke down in volatility. We came back, retested previous support, acted as current resistance, and we rejected that yesterday. So as long as we're below 30, or maybe even 31 in volatility, I think the stock market's going to be very well supported. We start breaking higher in volatility, you know, we start breaking back above this previous, you know, support. And once that resistance is broke, and this is what I drew yesterday, that's when you have to start worrying about your longs in the stock market. And that's like the one thing that I'm really keeping a very close eye on, you know, moving forward. But anyway, maybe we can get some thoughts from Steve. Steve, good morning. How are you?
Good morning, mate. I'm good.
All right. Well, Steve, what do you make of this reversal in risk overnight?
To be honest, you know me, I don't really pay attention to or call reversals in time frames like that, because my trading is, you know, has a different time horizon. So, you know, for me, it's just, you know, a little blip on shorter time frames. So, you know, doesn't really affect what I'm doing. For me, you know, a reversal would constitute something, you know, much larger. Of course, shorter term traders, you know, obviously have to treat that initially as a reversal, and then it looks like a, you know, false move. But, you know, I would agree with what both Stelios and you said. A lot of people are trying to fight this rebound because it makes zero sense from a fundamentalist perspective, which is true. And as long as that's the case, I think that, you know, equities might still keep holding, you know, quite well. Now, as I was saying on Friday, I honestly believe that the risk reward is stupid being long up here. That doesn't mean that you have to be necessarily immediately short as we speak, but I do think that the risk reward for being long is, you know, completely non-existent. At least not until we see a decent pullback.
Yeah. All right. Well, we have CPI coming out, so let's see what the data brings here, and then I will hold on really quick. Let's see. Let me move this out of the way. I'll stick around. I doubt this is going to move the market much, but we'll see. We'll see. CPI coming out. There it is. Should be out. And CPI came in a little lower than expected, huh?
Yep.
Yeah, but it's on a month that everything was shut down. So, I mean.
Yeah. Right. Like, is it really gonna be a factor? All right. Well, I'm gonna pass it over to you guys, and I wanna just wish everybody a great Tuesday. Just remember, it's very choppy out there. We might be in just a longer term consolidation, so just be careful. I'm so frustrated at the overnight moves. I'm almost at that. I'm fed up. I'm just going to step away from the computer type of attitude, which probably isn't a bad thing necessarily. So,
all right, guys, I'm going to Blake, they've transformed with what they're doing now. That they've transformed all markets, including FX, to a single market, and that doesn't really help in trading for the time being.
Yeah. All right, guys. Well, have a good one. I'll catch you guys on the daily roundup. For those of you that are Forex Analytics subscribers, if not, I'll catch you guys tomorrow morning.
Thank you, mate. Enjoy.
Thanks, guys.
Good luck, Blake.
Bye-bye. Good luck.
All right. See you, Coach.
Okay.
So
still, Dale.
Hey, guys.
Hey.
How have you been? Hope you had.
I got some sleep.
A nice good night's sleep. Yeah, great.
Yeah.
So what else did we have overnight, Silvio?
Very little, I'm afraid. We got Norway GDP came in at -1.5% quarter on quarter in Q1, which is exactly as expected, and
not that bad considering.
Yeah,
not that bad considering.
Yeah. So obviously Q2 is going to be more.
Of course,
it's going to be worse and more important. But let's see. But for me, my main worry is still, like I said before, what happens next? What happens in the next few months as economies open up, and crucially, what happens as we get into the winter, where viruses and all that, they tend to spread easier. So that's my fear. I really hope I'm wrong, but I just can't see how this is going to be the end of it. And we're all
and by the way, Stelio, since you mentioned Norway, let me say what we've said multiple times in the past. Under normal circumstances, economies can really withstand, a recession or even, such a bad development like, COVID. Unfortunately, with fiscal responsibility having gone out of the window for the vast majority of economies, that's not the case because there is, huge weakness, underlying weakness. But Norway, as with Germany, is one of these countries that can actually afford to have even a deeply negative GDP print. We've said it before, Norway has on the side roughly $1 trillion in its sovereign fund, which they can tap whenever they want if they really need to, plug a hole in their balance sheet. And Norway has a debt to GDP of roughly 40%, if I remember right.
Yeah, somewhere around there. So it's
which is
very low levels.
Yeah, which is for today's standard a joke. So, oppositely from many other countries, Norway can actually have a really bad year. They can actually do what Keynesians, traditional Keynesian theory would suggest, meaning, do a little bit more public spending, increase their deficit in the short term, and still not have a real issue about it. But that's not the same when you have an economy that's running huge deficits when you're still in expansionary territory, and then you have to run, amazingly high deficits just, because you are in a recession.
Yeah, these days, if you are below 100% debt to GDP, it's considered a success, right?
Yeah,
fiscally responsible.
Yeah.
And the worrying thing is that this is not reversing. This is just keeps going. Look at the US.
It's
UK,
actually accelerating.
It's
Europe,
not
that it's not reversing.
It's accelerating. It's not even decelerating.
No,
towards. So what does that tell you?
Second derivative is actually increasing.
Yeah. So what does that tell you? The purchasing power of these currencies is going to diminish every year, and we see this in our own lives, in our pockets. I've said this thing so many times. You go to the supermarket. I remember going 20 years ago with the same amount of money, and or 10 years ago, you can buy a tenth of what you could buy 20 years ago with the same amount of money. It's crazy, and this kind of inflation, it inflates away the debt, obviously, of the country, which is good, but it deflates your
mid
spending.
90s, Stelio. My mother gave me the equivalent of 20 euros, and with that money, I could actually take a taxi 25 kilometers away to Vula, to my friend Paris, stay the weekend there, go watch movies, eat at McDonald's, play
Video games?
and then take a taxi and go back home. Now
How old were you then? 30?
15 years old. Now it's 20. Now I would need those 20 euros just for the taxi ride one way there.
Yeah, exactly.
That
Well,
tells you everything.
Stel, if you change your diet, it could be cheaper. Like you could barbecue a flat screen TV. Tough to digest, but cheaper.
Yeah, very true.
Yeah, cheaper by the day.
Yeah.
Anyway, that's my worry about the general state of the economy, and I hope we get out of this. Not only Greece but every country. We get out of this without too much damage. But I'm doubtful, unfortunately. Anyway, so nothing else really today. Overnight's been quiet. We had some inflation numbers out of China, marginally weaker, if you believe them. And
I mean, I don't even, I've stopped paying attention to Chinese numbers. They don't make any sense anyhow. I mean, whatever.
Yeah.
And
I just
I'm pretty sure that the market has stopped paying attention to them as well.
I just want to remind everyone that last week when Mark Newton was on, he was talking about a Bradley turn date that's due this week. I didn't ask the day, but that's one of the reasons why I'm fading S&Ps today. So just to keep that in mind, the Bradley turn date was very good.
Speaking of the S&P, Coach, I think with what we are seeing now, I wouldn't be surprised to see another push higher to take out this previous high at 29.73, whatever it was, because we're clearly seeing the market holding up well from a technical standpoint. And as we were explaining before, since this rally makes no sense, and if you want to look
what
at
would
the Nasdaq,
change your mind, Steve? Action back under 2,900, would that change your mind?
Oh, for me, I'm still short the S&P. I'm a little bit out of.
If we take out 2,900, you still think we're going to take out 2,975?
I think we're going back to 2630, 2640, my target, more or less, no matter what. I just don't know if it's going to be from here or from a little bit higher. By a little bit higher, I mean there is a very nice confluence of resistances at 3,015, which would also squeeze a lot of people, because we're going to go past the psychological barrier of the round number of 3,000. So a lot of people are going to be throwing in the towel and being taken over by FOMO, and that would be a nice place to reverse, since this initial reversal lower didn't seem to have to produce follow through. Now, that doesn't mean that it's unlikely to fade from here and not post a higher high and show a divergence with the Nasdaq, because the Nasdaq, as you see, has clearly posted a higher high, while the S&P hasn't done so yet. Keep in mind also that the Nasdaq has actually, from the 20th of March, so less than 2 months, ran higher 41%.
Yeah, so I mean, who's still short after this? I mean, they've ripped the bears' faces off here.
Yeah, absolutely. I mean, completely. They've completely managed to squeeze out everybody. And keep in mind that this is not a situation that we had some kind of a technical, brutal sell-off. I mean, the markets sold off for one of the best reasons you can ever have for a sell-off. Economies completely shut down. And there is no reason to believe that they can recover from this shutdown unscathed. In my opinion, there is absolutely no way. There is no precedence, and there is no way. So bottom line, there is no question about it. The Nasdaq is currently at valuations that are hugely more expensive than they were in January and February, because earning expectations, of course, are plummeting, and Nasdaq is almost at all-time highs, which means that valuations are a lot higher than they were at all-time highs. So if you thought we had an overvalued market in mid-February, we have a lot more of an overvalued market in mid-May. And if you also add to that the factor that there is a lot more uncertainty out there about the fate of economies, etc., it makes even less sense. But it doesn't really matter, because this is a liquidity move, and as we said before, fuel oxygen to the fire. Oxygen to the fire, in essence, is people trying to fade this move prematurely, because a lot of people were trying to fade this move from much lower levels. I mean, I was thankfully long until 28.50 roughly, but I remember that a lot of people were trying to fade this move from like 24.50, 2600, etc. So especially these people that were trying to fade the very beginnings of this rally have really been destroyed from this market. Anyhow, as I was saying before, they've made everything a single market with all this intervention currently. So you're seeing that FX, the vast majority of FX pairs in one way or another, as the S&P is now stuck in a consolidation, they're also stuck in equivalent consolidations. You can see the cable here. You can see the Euro USD here. If you remember, I warned you in advance that you shouldn't be trading any of that, because in essence they are trapped in consolidations, and the only thing they're doing is like producing some one day moves that seem to have some strength behind them, only to prove that it was like a firework and nothing more than that. So I still think that as long as the Euro USD is trapped between 1075 and 110, there's absolutely nothing to do here. As long as the cable is trapped in that consolidation, which can either prove to be a head and shoulders formation or a triangle, there's nothing to do here. The DXY index itself is trapped in a triangle. You can see it clearly here. So, I know it sucks. I know that, it's, I would really love to have every single day something different to say here. But, during the past few weeks, the situation is more or less unchanged. And it is, until we see risk taking another leg lower, I don't really expect for the dollar to do much, and don't really expect for commodity currencies to do much as well. Metals, same type of story. Gold, coiling, the triangles range keeps shrinking and shrinking. We're now left with a range that's like between roughly 1685 and 1715, let's say. So, $30 range roughly left in this triangle. So sooner rather than later, we should see a breakout. Silver has already done the move. So silver has already broken to the upside. And in my opinion, that's the most likely direction that the gold is going to break as well. So I would favor another leg higher for gold. Crude oil, still bumping its head on this confluence of resistances at $20, still holding up quite nicely. But on the other hand, until it manages to penetrate through that zone, the risk reward would still favor short positions. But keep in mind that if it passes through 20 and we close above $20 in the continuous, I do believe that there is a very high probability that people are going to get squeezed with another move to the upside, which can be, how crude is. I mean, it can easily produce at these levels like a 10% move higher, without much trouble. So that's an overall description of what is happening at the moment. Let me go through some of your questions and see if you have something else in mind. By the way, needless to say that bonds are also in prolonged consolidation. Here's the 10-year yield. Here's the 10-year bond. Like this triangle, coiling, shrinking. At some point we should break out as well here, but we haven't done so. Here's the Bund. Bund looks a little bit more clear. I think there is a decent probability that this recovery within this wedge is going to break the downside. So bonds look more vulnerable than treasuries look here. And if that's the case, Euro USD might squeeze a little bit higher. But as I said before, as long as it trades below 110, it's not that I can suggest much of an action there. So let me see if I had anything else. Okay, let's go through the questions. Dale, I don't know if you're here. People are asking about your sister. As far as I know, she's out of the hospital, so she's better. Thanks for asking for his sister. So she should be okay. Copper, yeah, copper is actually moving lower this week so far. So we had a nice tweezer top yesterday, which can prove to be a reversal, a bearish reversal. Keep in mind, as I've said, below 248, the path of least resistance remains lower. So add to that the fact that we had that tweezer top, and I would have to say that from a risk reward perspective, I would definitely favor shorts here in copper. Having said that, a single candlestick is not enough. I would want to see more. But in any case, it looks like a corrective rebound so far. So
Hello, Steve.
Hey, Grega.
Hey, how are you?
Good. I didn't know you're coming today.
Yes.
Actually, it's great having you because the market has really not moved during the past several days. So it's a good thing, good getting your perspective as well. So why don't you grab the screen and show us what you have in mind here?
Okay.
We've already seen a lot of instruments consolidating, which is very annoying.
Yeah, actually, you just talked about copper, right?
Yeah.
Yeah. I think that copper is having a very interesting structure. We are recovering quite nicely, and looks like that this bounce is happening the same time when the stocks also recovered, and it appears to be a leading diagonal. So we may face a temporary resistance up there, but because of this 5-wave structure, but still with overlapping recovery, I think that there can be opportunity to join this uptrend, but after a pullback. So at the same time, I think we should be aware of potential limited upside on Asia as well. As you know, those markets are
very highly correlated. Yes. Yeah.
So
and to be honest, that also means the same for stocks, because we've seen that the Aussie and Aussie yen, Aussie USD and Aussie yen have really been moving tick to tick with stock indices.
Yes, exactly. So it looks like that we are turning into a new trend. I would not be surprised to see Nasdaq 100 hitting a new all-time high before we see a pullbacks. But I think that just next pullbacks, whenever they occur, could be opportunity to really join these trends. So I'm very bullish on stocks, but I'm just aware of potential setbacks because we have 5 waves up. Not only on copper, we have the 5 waves up. If we look on Aussie dollar here as well from those March lows. If we go also to the S&P 500, you can just let me find the charts. You can really nicely count 5 waves to the upside. Maybe even better, it's visible here on Nasdaq. Okay, we have 5 waves up back into this gap. So I think that this February gap could be very important. I mean, Nasdaq is one of the strongest indices, obviously, So if this market slows down at this gap, then I think that this could also happen or have an impact on other on the S&P 500 and Dow Jones. So just be aware that we are moving into some very extreme levels here, where a lot of traders and investors who were very bearish are now maybe realizing that after all, trend is back to the upside. But I think that they are a little bit late. We are moving into the phase of the sentiment, which is now in some positive extremes. So I think that it can actually be the opposite of what others would think. So just be aware of pullbacks, and ideally we will see those reversals forming still this month.
I'm actually short the S&P, Greg, and happy with it, but my target is not very, aggressive. I'm looking for a return to 2630 to 2640. That's what I'm looking for.
Yes.
And perhaps depending on the nature of the pullback, I might actually go long there.
Yes, I mean, the very interesting first support where I would pay attention on is at 2720. The next one would be this at 61.8% at this gap, which is open from start of April. So this is also very interesting. So now imagine a lot of traders, investors are seeing, especially maybe media, if you are watching CNBC, they are seeing stocks back in uptrend. Okay, everyone will now become bullish. You will see a pullback. Now imagine what will happen with all of those when you see market or prices dropping all the way back on the S&P towards this level. Again,
everybody will turn bearish again.
Yes. So I think that this current context and with crowd sentiment, it's perfectly matching of what is going on the markets right now. And it's
what do you think about the dollar? Obviously, without even showing the dollar, I would expect that you would expect the dollar to strengthen once we do get this move lower in risk. But what happens from there? Do you expect even weaker prices?
I mean, I was looking and observing different possibilities during this weekend. I still think that the overall picture for the dollar, or maybe euro dollar, if we're just trying to focus on dollar index, is still a little bit tricky. But I just came out with this very clear perspective, because in a complex structures, I will
ABC with the triangle being B.
I will try to pull out something that is the most clear to me. So, I mean, what's going on there? We have seen a very strong drop here in March, and then since then we are just consolidating. Okay, I'm not sure how this will play out with stocks. Maybe we'll see this market pulling to the downside because stocks will maybe, after all, now imagine if Nasdaq 100 will rally to new all-time highs before pullback occurs. It means the dollar index could actually still see some weakness here. But from a clear perspective, Elliott wave pattern looks to be a triangle forming in a wave B. I think that the wave C to the downside would not be a big surprise.
What is the bigger structure, though? What is the bigger count that you have in mind having to do with the US dollar?
It's a little bit tricky count. I'm looking for expanding triangle. I could also show some other wave counts, but all suggest the same, that we are still in this wave B complex pattern, and that whenever we get this drop out of a triangle, I think that there will be a new opportunity, because you cannot say that this is wave 2, because triangle never occurs in a wave 2. So I think
only in 4 or in B.
It will be just a matter of price where we stop, either around 97 or maybe we'll have to wait till 94. So when we're looking at the dollar index moving to the downside, at the same time, right now, okay, you can see that in the last few hours, dollar index is falling quite sharply. But watch out what dollar yen is doing. Dollar yen is holding a bit quite well. So at the same time, we see euro dollar moving to the upside. So when trying to combine everything, and still we have a risk on still in play, right? No matter what I think it may happen next. So I think that it's very interesting to look at the euro yen, and I will show you this structure. I think it's a very significant, very important. So first one, we go to the weekly chart. Okay, now on the weekly, what you will see is that drop from end of January, it was a move in 7 swings: A, B, C,
Double zigzag.
Okay. W, then you have X and another ABC. We stopped recently at the 78.6%. At the same time, what I really like the most is that there was a gap here back in 2017 in April. Okay, at exactly 2 years back. Sorry, 3 years back, this gap is now filled. And not only that, we have seen a spike below this wave X just for a few pips before market reversed to the upside. And this was why I think this is significant, because exactly from that point, you can see that market was in extreme bullish rise. So it's obvious that something happened out there. Okay, so I'm thinking that market may be bottoming here, especially as I said, we have complex corrective structures. We have 78.6%. We have seen gap filled. We have seen a spike below wave X. And now if you go to the smaller time frame, you can actually see that this recent decline was made by this wedge pattern. I see this as an ending diagonal. It's a significant reversal pattern. Not only that, if you go to the smaller time frame, you can count now from the lows. You can count
five waves up.
Yeah, so I think this is everything why I'm looking at the Elliott waves in general. We have on this pair. Okay, we have correlations. We have dollar yen turning bullish. We still, even if dollar yen and stocks were in negative correlations, maybe this will now finally come back in play. Then we have euro dollar moving to the upside because I think the dollar index could actually break down from this bearish triangle. And after all, even if I just try to ignore the correlations, the other markets, I look only at the euro yen, it's still a very clear pattern from significant reversal from very important levels. So I will look for this pair at myself. We'll watch for this ABC setback, and I'm ready to go long on a pullback.
Okay, perhaps back to wave 4.
Yes, that would be first support at 116. The second is at 100.
Is the top of wave 1, yes.
Yes, exactly. That's the zone, of course.
Which is also horizontal support resistance area. I mean, that 115.50 to 116 area is quite a significant horizontal support resistance area.
Yes. So euro, I mean, it's not only the euro yen, you have also, maybe if you're just trying to go away from the euro, because after all, euro is still a mess. You have very good structure on pound yen. Let me just open pound.
It's not that the pound is free of trouble, you know what I mean?
Yeah, of course not. But look at the euro pound and you see where the trend is. Euro pound is coming to the downside, and we have pennant there. I see bearish triangle, so maybe after all, pound will be better than euro when looking at against Japanese yen. But looking at this structure, I mean, we have 3 waves down, and looks like that we could see a jump in price here for more upside, even if this whole
to be honest, Greg, somebody doesn't need to be very experienced to see that the structure in pound yen indeed is not impulsive in the downside in any way. So I mean, the price action is clearly slow and overlapping there. So I'm with you. I mean, the pound yen looks like it can squeeze higher from here.
Yeah, and cable, I mean, cable is also, I think, in a bullish mode.
Yeah, it's either, I've been saying this is either a triangle or a head and shoulders formation, and we're going to know pretty soon which of the two, right?
Yes. And I'm also looking here on the 4-hour for a triangle. It's my first primary interpretation. The next one is that we already have seen the first 5 waves up here, topping in mid-April, and we are now in ABC phase, meaning that we could maybe spike down to this former wave 4 and then a bounce. But both structures are corrective, and the reason is because we have seen in the first leg here, we haven't seen a 5-wave move, but we have seen a 3-wave drop. Okay, so even a following rise was overlapping here. So I'm thinking that this is either a part of a triangle or a flat, and both are corrective legs, meaning that sooner or later we may see a resumption higher here on pound.
Great looks, Grega.
Hey, Dale. Thank you.
How are you? Nice
I'm fine.
looks.
And you?
Grega,
okay.
Right.
I have a fast question for you because we have the interview afterwards. USD CAD and USD NOK. have they found a high, or they're just consolidating the explosive gains before they move higher?
I mean, dollar cat, looking at this structure, it's a little bit messy.
I know.
But I still think it can prove to be a corrective, but watch out for potential, even if we see a drop below this double bottom here, I think it could be a failure one, and that later we will see a bounce here. I think that what we really should be watching is obviously crude oil, because crude oil is in a recovery mode, but it could be in a wave 4. What I'm concerned about is that even if we are in a wave 4, there's still this gap opened from
which is a lot higher, huh?
Yes, and it's a lot higher. Yes, exactly. That's why I would be very careful with GAD and NOK at this stage until we see a completed fourth wave, which is not the case. The first resistance is not far away at the 38.2%, but maybe even much more important one is the second zone, this gap.
Okay, perfect. We have another request, but I think there is no time. If you want to jump on the chat room, there is a member that are asking for Swiss yen. But Coach, is our guest here?
Yes, Chris is here. In fact, I bet Grega knows who Chris Carolyn used to work with. Ever hear of a guy named Robert Prechter?
Sure.
Okay, so anyway, I thought you might have. Just a long shot. Anyway, yeah, Chris is here, and I'm getting him set up as a panelist. And
thank you very much, Grega.
Grega, yeah, great looks, buddy.
Always helpful to have your point of view.
Okay, so where is he? Is he up there now? I made him a panelist and I don't see him.
I see.
There he is. Hi, Chris. Are you unmuted? Oh, there you are. Okay, let me unmute you. Welcome back to Phase, Chris. Welcome back, buddy.
Hi, yes, good to be here.
Yeah, good to be anywhere nowadays. So I'd like to open it up with this question. Are you finding the markets a little more challenging in this pandemic than the last one? Oh, you're not as old as me, Chris. Okay, so.
Actually, my father, who was born in 1909, had the 1918 flu. And
wow.
He remembered the quarantine, and he used to tell the story about being quarantined. And then, you know, just like today, everybody needed a haircut when it was lifted. And his father took him to the barber shop in Boston, and there were always two chairs there, but when they went, there was now only one barber. And my father went into medicine, and so he became, you know, he was very interested in, you know, he used to say that we're going to have another epidemic.
100 years
will come.
Yeah. Did the anything the spiral calendar point towards this type of historical event?
Well, not this event, but you know how what I really want to talk about today is the long-term picture, and obviously the pandemic is part of it, but I think even more so, you know, the government actions and the Federal Reserve, and you know, a question that's been boiling in my head for a couple of years is how the Federal Reserve actions and their interventions and money printing and all, how does that change long-term cycles? And can the Fed defeat cycles, or do they only postpone them? You know, that's
it's a big debate.
If you believe that there are some fixed cycles at work, then that becomes a more interesting question. If you don't believe in fixed cycles, then you can just think, well, the Fed is just going to blow things up and then destroy them and whatever. But I've always been interested in, well, what happens to these cycles after all this activity by governments intervening in free markets? So that's kind of the theme here today. I put together some slides.
Okay. I'm interested.
And we can go with that.
So should we, what season are we in here, Chris?
Well, you know, that's
winter.
that's the thing, because we should have been in winter a long time ago. But the Fed kept pumping in all this money. They, in a sense, prevented what should have been a natural collapse to occur either after the 2000 top or after in 2009. But they just kept flushing things in. So,
And
this
again
is
now,
sort of the
right?
classic. The first slide is the classic long wave model of prices rising and falling, and then equities doing 2 cycles within that cycle. Here is it playing out across the data, mostly in the 20th century. And you have these really healthy stock markets during spring and fall, but summer there's too much inflation for stocks, and in winter there's too much deflation for stocks. But what I noticed when looking into the long wave was that there was this double tops and double bottoms that are very regular, almost 7 or 8 year separations between them. And my investigation led me to eclipse cycles as really the driver of the long wave. And we have lots of eclipses. There's every 6 months there's another set, but not all eclipses.
Lunar or solar, Chris?
Pardon me?
Lunar or solar, which has
well, I'm
more
really
significance?
In terms of market tops and panics, I'm looking at solar, but both. What's interesting is not all eclipses are equal, and I had a discussion. This work kind of came out of discussions back and forth with Arch Crawford about 22 years ago. And, he would say, okay, the certain eclipse is important because planet Y is doing whatever. And I'm like, no, planet Y has nothing to do with things. But it turns out that the eclipses where everything lines up more centrally, in other words, how close is that alignment between Earth, Moon, and Sun? Those central eclipses are the ones that are important. So, this is a chart goes way back to 2002. And so, looking for this pattern of double tops and double bottoms to repeat, and then, asking what happens with the Fed action. Well, now in spiral calendar terms, the 27th spiral calendar time unit is 35.8 years. And that is very close to 2 times the eclipse Saros cycle, which is 36 years. So the first clue for me that the Fed can't get rid of cycles is when gold bottomed within 12 days of that anniversary of the 1980 peak, and that gold low in December of 2015 to me is extremely important because it says that there. I guess I have a dispute with deflation. I mean, there's deflation going on now, but in some terms, we've already passed the deflation cycle. The fact that gold bottomed in 2015 says that was over. And but the Fed actions have prolonged things, they've postponed things, that we failed to clear markets of debt, et cetera, et cetera.
Not many would view this chart in current conditions and say that there's potential that this last rally from the Deets 2015 low could end up being a failing rally, Chris, and we get one more whiff of deflation.
I think definitely not, because of the timing. And so it's interesting. I know there's a fellow on Twitter, I think you've had him on, Henrik, and I went head to head with him a year or two ago and he correctly was like looking for deflationary collapses like we've had in crude oil. But, we've watched crude oil go from 80 to minus 30, but the metals markets haven't cracked. And so
not at all. Yeah.
And what I think is going on is the metals markets are looking ahead
at yields.
Now this chart really is both gold and the 10-year yield. The yield is inverted.
Okay.
And that same 35.8 year cycle. So this was, I did some long-term videos for subscribers back in January. This slide is from that. And we would have expected, without the Fed acting, you would have expected rates to bottom a few years ago, but they didn't. And so I was looking at the spiral calendar anniversary of the second rate peak in 1984 as marking the end of the bond bull market. So in January, I was really called for the bond bull market to end around the 30th of March, plus or minus a couple of weeks. And
great call.
Yeah, and
180.
The actual top was the 9th of March, and now it's a wounded. I mean, bonds are kind of over. It's a wounded market. The Fed's going to support it, but they've got so much paper to issue. Where's the confidence? I don't think this ever comes back. So
yeah, I'm in that camp, Chris. Do you think they've taken the markets away from us? And I was thinking about this, like, they're going into junk and corporates, and maybe they're doing that at the expense of sovereigns, because the sovereigns.
Of course. I mean, it's right. I was looking for a top in the bond market, and what we got instead was they blew it up. I mean, they just detonated it, and it doesn't mean anything, right? I mean, what's sovereign money mean anymore when they're printing whatever they want or buying whatever they want? It's all kind of crazy.
Your previous slide says that we have the one before the one more back, because I just want our viewers and have you on record that we have something major coming up around the solstice.
Well, yeah,
the eclipse.
This is the second part of the discussion today.
Okay, go ahead. Okay, I threw you off.
Yeah, and
we'll come back to it.
It's good. We needed to go back to this slide.
Okay.
The 1984 peak in rates, the second, the high in rates was 81, and then it made a lower high in 1984, and that occurred on the exact day of this eclipse, Saros cycle 137. I mean, literally, the eclipse shadow was crossing Manhattan Island when bonds bottomed and rates peaked, and so that same 36 years, that eclipse is due in June. Now, what's really interesting is this eclipse falls right on the solstice. I mean, it's literally 9 hours apart, I think, from the perfect solstice moment.
That's why I noticed it.
Eclipse.
Yeah.
But
I'm an amateur planetary guy.
Yeah, but that eclipse cycle 137, that was also the recovery high in 1930. Yeah, and you remember we had we don't remember, we weren't around, but the crash in 29, and then there was this relentless rally, and it went further than everybody thought. And it I think it topped about 11 days before that eclipse in April of 30.
Interesting.
So now I think we're in this similar situation, and I mean, to me, the cycles, they're the emotional component. They're the thing that people can't put their finger on. When people say, "Gee, why the heck is the S&P going up when the world is ending?" Well, it's because we're still in this very strong emotional cycle. And I think once we get into June, somewhere around June, this thing's going to roll over, and then it's dead. Here's another chart from looking at that long wave seasonal model, and this was the rate low. Here the question marks we filled in. Now we've got that in 2020. The gold one was in place, and the central banks, again, they were just pumping in crazy money and preventing the stock deflationary collapse. And so what I think that the result of the central bank actions ultimately is that we just jump right up into this point A here. And springtime in the long wave cycle, that's the time of healthy growth with low inflation, and we're not going to get that. We're just going to go straight up to the spring into summer, where we're going to have inflation and bonds go down and stocks go nowhere, and the metals shine. And I mean, it's the 70s all over again.
Okay, well, you and I remember that, Chris, but it's really, and the market is set up for that because everyone's more interested in shorting the market, and the most crowded trade on the board's long bonds everywhere.
Yeah.
So, really, it's great to have you here to confirm some of the things that I was saying. It's some interesting work. So basically, bear market in bonds, bull market in gold and silver, and what do you think as far as the dollar is concerned? That's going to also in the 70s.
Well,
We had weak dollar.
I think it gets pushed higher here.
Yeah.
But I don't. It doesn't really figure. I guess. The late Ian McAvity. I just always loved his line. Best looking horse in the glue factory.
Oh yeah. Okay. Yeah.
that's the dollar.
Poor Flicka.
Yeah, poor Flicka. This is another just a plot of solar eclipses based on their Saros number. So in other words, eclipses at the extremes are just partial ones, and so at the center, and you can see these were important market tops just occurring right on. Is at 1937 and then 1973, and I think part of what the Fed did is really pushed us out, and they bought some time, but the bills are still coming due, and then on the bottom underneath that central line, you can see where the panics and the crashes happen, and it's 36 years, then 58, and then it should be another 36. We should get some kind of panicky thing in the summer 2023.
That is also interesting. How your work lines up with that date. So it looks like the Fed bought us a few years with this action.
Yeah,
to keep the party going.
I just think they keep making a deal with the devil, and back in 2000 they said we don't want a recession, and so so the stakes got raised to a depression in 2008, and in 2008 they said we don't want a depression, and the money printing raised the stakes to credit implosion, and now we've had credit implosion, and they say we don't want to pay the price. And I mean, eventually the price to be paid is societal collapse, and but the Fed is in it for the Fed, and the bankers keep the politicians in power, the politicians keep the bankers rich, and neither one of them cares about us too much.
That last statement you said, like a lot of people say, well, that's really, oh, you're negative, you're an alarmist, but if people just look around at what happened in a month's time, this type of event, where if it wasn't for government intervention and giving people some float, which isn't going to last forever, I still think we're going to have. There's a difference between the stock market rallying and what the economy is doing. But people, when you talk about societal collapse, what if there weren't stimulus checks that went out? What if there wasn't money for unemployment insurance? So, you really can see what's happening with the supply chain and meat plants closing and everything that, people like you and, amateurs like me have been talking about this possibility for a long time, that we were, you need to be stabilized, maybe go get some lithium. And, I think that we've witnessed really being on the brink. And I think that people could actually understand how there could be a societal breakdown after watching what's happened here.
And just because, and the extent of, I mean, they're handing out lifelines, and so, but it's just so obvious that most people who are just been impacted aren't getting the help. The fat cats lined up to the front of the trough and got theirs, but just the devastation in small businesses across this country, and yeah, it's all very scary.
Yeah.
But we
Go ahead, Chris.
I do some interesting short-term work with tides.
Oh yeah, I went to your website and saw this title stuff.
As well, spiralcalendar.com, which is you can see there in the lower left.
Okay.
We're interested in my work. Now, this tidal sum, this is really just from a point on the East Coast, it's showing you in feet the combined drop from high to low tide of both tides during a day. There are 2 tides every day.
Right.
Almost.
Right.
So this is a pretty good way to look at the data. What's fascinating to me about the tidal work is that when markets are emotional, it's very effective. And then when markets are unemotional, just throw this chart out. It has no value at all. This chart was useless in December and January and into February. And then once we made that top, all of a sudden we're just really in sync with the tides and emotionally. And that's still going, right? I mean, 429.56, we're just got that rhythm nicely. So it's pretty fascinating work, and it's good also because whenever the market moves against the tide, to me, that's making a statement about the trend. So in early April, when the tide was dropping from 4.1 down to 4.8 or so, and markets went against the tide and they advanced, that it was important information about the trend that it's stronger than people think, and right now we're we went down during the most recent down period, but we didn't go down that much, and now we bounced right back up again. So this might give us an early warning of things. I don't know that we can fully keep this going into mid-June all the way to that eclipse, but I think we've got enough momentum and still enough fuel at least to go a few more weeks.
Chris, I really appreciate Thinker, and your work is very fascinating to me, and people can follow you on Twitter at SpiralCal, and your website again, Chris, is www.spiralcalendar.com.
Yes.
That's
And
it.
so thank you for having me. This has been very nice.
Yeah, and it's great that you have you were here today. I tell you what, I'll be paying attention to this eclipse and solstice coming up here in June. So
Yes.
Thanks for edifying me and the community today and opening people's eyes up to there are things besides candlesticks when it comes to interpreting markets.
Yeah. Well, candlesticks are good too, though.
But I enjoyed it, Chris. And
thank you, Dale. Thank you very much.
Like it or not, you're my trading warrior brother.
All right, I like it. I'll take it.
All right, everyone, that's Chris Carolyn, and that's a wrap for our Turnaround Tuesday. Don't just count your pips and eclipses and tidal waves, count your blessings, and we'll see everyone tomorrow. Adios. Thank you again, Chris.
Thanks.